All right, well, welcome everyone to another market update from Principal Wealth Partners. I'm Julina Ogilvie, partner and wealth advisor here at the firm, joined once again by Bob Paolucci, our founder and CEO. Bob, we're back.
Good evening. 5 p.m. on a Sunday.
Oh yeah, so this is a special edition. We did our video last Tuesday. The Fed met with their very anticipated meeting on Wednesday. They raised by 75 basis points as anticipated. However, the markets had a reaction, the economists had a reaction, and we also have a reaction that we would like to share, if that's fair to say.
That is fair to say, Julina.
Okay.
So,
where would you like to start?
Well, so here we are now officially in fall, I believe, correct?
Yes.
And that's what the calendar says. That's what we know it is. The seasons change. Mm-hmm. Fed came out on Wednesday, and we thought it was a recording from months ago. They seem to lack awareness of the damage they've done to the economy already. They were talking about backwards looking inflation. It's almost like they were talking about the past, and they forgot that we moved into fall and the clock is ticking. So that's really the catalyst for us to have this video. We hope to keep this one a little shorter, but we didn't like what we heard. And Fed came out, they increased rates by 0.75%, which was expected. The market had it priced in. They talked about, in the future, they want a low inflation, low interest rate environment, which will create a very long bull market. We'd love to hear that. Very briefly, the market, as the Fed was talking, rallied as soon as they heard that. And that's really where they're going, right? That's where they're going.
Right. And that's positive.
That's very positive. Yeah. To actually have them talk about it is very positive. However, what nobody liked is how they're going to get there, because we all think it is lacking awareness of what's really going on. And we also think it's not going to be possible without doing a little bit more damage to the stock and bond market.
Sure. So, and Bob, it's fair to say that was the market reaction, right? It wasn't that the 75 basis points surprised anyone.
That's correct. The 75 basis points was already priced in.
Right.
I would even say even a little bit more was priced in.
Sure.
But their path, which they put together through something called the Fed dot plots, right? They put a target on monthly and quarterly interest rates. Mm-hmm. They increased their dot plot by a significant amount, meaning they think they need to raise rates by another 1.5%, which is mind-blowing to us, and probably to anyone you may have listened to on CNBC or Bloomberg or any other financial news show, because it's too much.
And Bob, can you remind us how much they've raised it already since we started this?
Yeah, so we started the year at, for the most part, 0% interest rates on the short end, right? It was, they refer to it as a quarter or a target rate, between 0 and 1/4, and we're now at 3 1/4.
Right. So
they've increased by a full 3 percentage points. Mm-hmm. That's the target. They quote the high end at 3.5. We won't get into that. So they've done a tremendous amount of rate increases, and me and you, this firm, a bunch of other large institutional firms, a bunch of people on TV believe that they've done too much too fast. We think they certainly can get to these higher interest rates if they were to take a slow, gradual approach to get there. We don't think that they're going to be able to pull this off. And if they do try to do it, they are making clearly a policy mistake. And what that means is they're getting into a restrictive zone. They really want to slow the economy. They want to hurt housing. They want to create a lot of unemployment, which ultimately, could lead to a real recession, not just the 2 quarters of negative GDP growth. This could be 2 quarters of negative GDP growth or more, plus depressed housing values, less economic activity, a lot more unemployment. So more of a real slowdown.
Sure.
Again, we don't think they're going to be able to do that, but based on the way they are speaking, we don't want to take any chances. So if you're listening, you have probably seen some trade confirmations come through, noticing that we've rebalanced your portfolio to be much more conservative, at least in the short term. And we are trying to take advantage of this down market to buy in if it goes down, further from here. And it can. And the market really isn't trading on fundamentals because there's no data that's coming out. It's really based on speculation of what the Fed is saying, right?
Right.
As they say, don't fight the Fed. It doesn't mean they're always right. Rarely are they right. It only means that they are in control. You have to understand that. So don't fight the Fed. Isn't that they're right? It's they have the control. So we are going to, and we have been sidestepping sort of their hawkish tone going forward.
And Bob, when is their next meeting?
Their next meeting is around Thanksgiving.
Right.
So they take October off. They'll meet again after the election, right around Thanksgiving. So there's a period of time now before they come out. There is a chance that many people in Washington have a discussion with them to say, you sure you're doing the right thing? You really know what you're doing? I think they are just lacking awareness of what's really going on in the economy and, what could go wrong. If you're listening to the television financial news, I hope you're not, but you probably are, you'll hear that this has been orderly. The markets have sold off in an orderly fashion. The bond market has sold off in an orderly fashion. I laugh every time I hear that because you have a stock market that's down 25, 26%. You have a bond market that's down 30%, right? So long-term government bonds are down 34%.
Right.
Core bonds are down almost 20. The US dollar relative to these other currencies really has never been stronger. And you have chaos outside of the US. I don't know how orderly you can call that.
Yeah.
Right. At what point do you say, hey, maybe it has to do with interest rates going up too far, too fast, and by too much?
Absolutely. And this has been part of the discussion of economists and strategists talking about the fact that they would eventually have to cut interest rates.
Yes. So here's the other fascinating thing that came up in the minutes. It was like a very confusing conversation that the Fed had with, I think, themselves and the media. In the same vein, they're talking about short term over the next year or so, bringing rates up to 4.25% to 4.5%. But then looking out 2 years and 3 years,
right,
bringing them down to 2.5%. So that's a significant amount of rate cuts that they themselves are forecasting.
Right. Just following this aggressive hike.
Absolutely. And actually, can we show them, Julina, on the Fed's own dot plot? This is right from the Federal Reserve. This was in their minutes. We cut it out of one of their pages. This is what we're talking about. So what you see, each dot represents a Fed voting member. And you can see that in 2022, this is by the end of 2022,
right?
They are guiding. Their guidance says that rates will get up to about 4.25% to 4.5%, which is going to be hard to do. They're also showing that in 2023, they might go a little further, maybe up to about 4.5% to 4.75%. But then starting in 2023, towards the end, and all the way down to 2025 and beyond, they think they're going to have to bring rates down by about half. So from 4.75 down to about 2.5. 2.5 that I circled on the right is the long-term neutral rate.
Right.
In English, that means that's room temperature. Your room temperature interest rate is 2.5%. It's not too cold, it's not too hot, it's just right.
Is it fair, Bob? The other observation that's interesting is look how concentrated the dots are going into 2023. In other words, they're fairly in agreement. And then they start to separate going forward when they're thinking longer term as to where they should be.
Yeah, and the short-term guidance might just be them using their words to guide higher.
Yeah.
And again, this is why this Fed meeting was so unusual. Jerome Powell did say, don't hold us to this. We make decisions meeting by meeting.
Right.
So it was a way to hedge this dot plot. But you can't, they publish this, so you can't take it back. So I think they're, again, talking very tough. I don't feel that they're going to be able to pull this off. That would be good for the market if they don't. I think it's bad for the market. And to explain bad to you, it's probably a 5 to 10% decline from here. Which is unpleasant. And it's not, it could literally be a bad week or 2 bad days and then it's over.
Right.
But I think if they pull this off and they go higher for longer, I think they create some other issues. I think they really impact the credit market. I think they impact foreign bonds, emerging market bonds. I think they create some major issues. The currency market is already dealing with many issues. So I hope they don't pull it off. I don't think they can. And if they do, I think there will be other issues, which is why we lightened up this past week.
Right.
And we plan to potentially do that a little bit more this week. But at the same time, we'll be looking to buy, if there is a dip, a dip in this market, which we think there certainly could be.
Okay.
Just some other things that came out of this meeting. They talked about real interest rates. Real interest rates are what the 2-year bond, 5-year bond, 10-year bond, 20-year bond yields minus inflation.
Right.
So when you hear real rates, they want to make sure the 10-year bond minus inflation still has a positive yield. Right. Right.
Which it hasn't in over time in the last.
I think the vast majority of our industry can easily view that through the TIPS market, which is the Treasury Inflation Protected Securities market. So when you look out at the 1-year, 2-year, 3-year, 4-year, 5-year, 7-year, 10-year, 20-year, 30-year TIPS market, the bond market, which is almost always right, has inflation down at about 2 to 2.75% already.
Right.
And it's just pricing in a year from now, 2 years from now, 3 years from now, 5 years from now. So what you do is you take the treasury bond yield minus the TIPS yield. And if that gives you a positive number, then you have positive real rates. So the Fed said, we want positive real rates. Well, guess what? They have them.
Right.
Through every maturity, they have them. Now, I know where they were going with this, but they're using a calculation that almost nobody uses, which is the interest rates on Treasury securities minus their measurement of inflation, which is PCE, actually real PCE. They clarified that for all of us. But that makes no sense.
And can you quickly remind us PCE
at this point?
Can you quickly remind us what PCE is?
Yeah, that's CPI, generally speaking, is a measurement of every item.
Right.
Regardless of how you use it and how much you use. PCE is more or less weighting it based on the items that we consume, right? That most people consume.
Okay, thank you.
And it also PCE also includes, if you buy Bounty paper towel, Stop and Shop paper towel might be an alternative. And if that's a lower price, they'll factor that in.
Right, correct.
So the things that we use plus lower price alternatives or higher price alternatives, that's why that rate is a little bit lower, actually much lower.
Okay.
So, a very bizarre meeting from the Fed. led us to take action. We think they're hallucinating, so we took action, and we think we took the right action here. So we'll see sort of how it plays out. They confessed many things to us in this meeting. They said, look, interest rates are now in a restrictive zone. Restrictive zone is anything above their 2.5% neutral rate. And they said, yeah, we're being restrictive here, and we know it.
Correct.
But they also said we want to be more restrictive. Nobody likes that.
No one liked it.
Yeah, and I just think the fact that they're looking backwards at inflation, when they should be looking at what they've already done, most recent inflation data, and projecting forward, not backwards.
Correct.
I mean, who doesn't know that inflation is high and was high? Let's take what you've done the most recent month or 2 or 3 and project forward. Inflation is half of what it was. So yeah, kind of shocking to us for them to actually say that in public. And that's really it. And this video was really to let you know, as a client of ours, that number one, we are always looking at this stuff, paying attention. If there is a reason to reposition portfolios, we take advantage of it. And this was a reason. This was the potential for a Fed policy mistake that we talked about in our prior video this week.
Exactly.
And they said it, which insinuates they're going to make one.
We just weren't expecting it on Wednesday.
We weren't expecting this type of transparency.
Yeah.
I really think they are missing the boat here on what's really going on. Right. They'll find out soon. So
and we may have to wait a couple months for an update from them.
Yeah. So I'm acting like they don't know anything. Of course they do. They're struggling with 2 things: the unemployment data, which moves very slowly, right? It's easy to hire, it's hard to fire and lay off. So there's always a lag. So the unemployment data is going to come down. It's just going to come down a little bit more slowly. And then when it comes down, it's coming down.
Right.
Meaning more unemployed people. Their target for unemployment is 4.4%. Right now it's 3.6. So yeah, that'll be a pretty significant difference. 1, 2 is housing. The way housing is calculated in their formula is not a way any of us on this planet would ever calculate it. It's owner equivalent rents, which is a terrible way to calculate anything. They should be looking at actual housing data, like new home starts, how long homes are sitting on the market, the cost of money. So, I think the 30-year mortgage just hit 7.02, which is ridiculous.
Right.
And the fact that if they keep increasing interest rates from here, no one is going to sell their house if they have a mortgage, because most people have a mortgage at 2 or 3 or 4% at this point.
Absolutely.
Who's going to sell a house to move up, right? To get into a mortgage with double the interest rate.
At least, yeah.
At least.
Yeah.
So what does that do? Well, that creates a shortage of homes. What does that do? That might create more inflation. So it's just a very bizarre meeting from the Fed. Is what we have to say.
Okay.
So,
well, thank you for that insight, Bob. It's always appreciated. And I think, as our clients know, we are always willing to jump on these videos when we need to in times like this.
Absolutely.
So
yeah. And for clients, at the end of the day, we're very passionate about this. For our clients, when we're doing their financial plans and having conversations, our clients who are in retirement or looking to retire, they could have retired 3 years ago, 5 years ago, a year ago, today, right? This isn't going to impact your retirement. Emotionally, it might. Nobody likes to retire into this environment, but having as much money as you had, 18 months ago isn't a bad thing. having as much money as you had 24 months ago isn't a bad thing. You're going to be fine. This market environment, both in the stock and bond market, is creating an enormous opportunity for long-term returns. You know, when we were looking out at the end of last year, you know, looking at long-term returns, getting a 8 to 10% return, you know, from the longest bull market ever in history. I'm sure we'll be able to do it. How are we going to do it? You know, is it more growth stocks, more value stocks, more US, more foreign, more small cap, mid cap, whatever? Today, we have a bond market that now yields 150% more than it yielded a year ago.
Right.
We have a stock market that yields 80% more, just from a dividend standpoint, than it did a year ago.
Yeah.
And dividends are growing, buybacks are increasing, and PE ratios, is the market expensive or cheap, are way down, way down. So, you know, if you look out for us 2 and 3 and 4 and 5 year returns, we know that investing in these environments, looking forward from here, things look really good. You know, how we'll get that 8 to 10% return for clients, almost half of it now is going to be made up of yield,
Right.
Which is something we haven't seen in a very long period.
A long time. So
yeah, through all this short-term, you know, turbulence in the market, our view of the Fed, what we're doing, is really to allow us to take advantage of what we think are going to be spectacular longer-term returns from here.
Absolutely.
So.
Yeah. And thank you for sharing that. I think it's very important for clients to understand that our optimism has not changed. It's just the short-term concern that came out of the meeting last week. Yeah.
I mean, this market, the entire capital market system, whether it's the bond market or the stock market, even the foreign markets, it's all in the hands of the Federal Reserve. It doesn't matter how we got there. We're here.
There.
And the Fed is actually in control of all of this stuff. So you can't fight them. They may not be doing the right thing, but you can't fight them. And that's very short term. They tend to change their tune pretty quickly.
Sure.
So their wonderful long-term outlook, I'm going to go out on a limb and say it's going to change, my opinion, very quickly.
Okay.
Quickly. And we will be able to pick up on that in the bond market. Once yields push back on the Fed language, which it looks like they might be starting to do, that's going to be a clear indicator to the Fed that they need to pull back a little bit.
Sure. Change their tune a little bit.
Yeah, exactly.
Okay.
So stay tuned. We'll keep you informed. We just wanted to put this video. It's a tough market, but we know how to handle these markets. We've done it a lot.
Yeah. Absolutely.
We are now seeing lots of opportunity at these levels, and we're about to take advantage of it.
Well, thank you for sharing all that. I think we also want to reiterate that we realize how emotional this time can be. So I think that's really what drives these videos, is we want to keep you up to date and let you know how we're thinking about it. And absolutely always here, if anyone has questions or concerns, feel free to call one of us.
Absolutely.
Okay.
Great.
Thanks, Bob.
Thanks, Julina.